So, really early in his dental career, Dr. Bill realized that he had to be careful using clinical dental language with his patients. So, instead of saying, "You have decay on 30 that needs restoration," he'd say, instead, "Looks like there's a cavity in your molar. I think we should fix it before it causes you any pain." And I think that's a good example when talking about financial language and the financial language that is used by financial professionals like me, using terms specifically like above the line versus below the line when it comes to talking about taxes. Like clinical dentistry is to your patient, above the line versus below the line is confusing language. It's hard to process and take action on information if the language used to describe it's not familiar. And above the line versus below the line becomes even more confusing, in my opinion, under the one big beautiful bill. More on that in just a little bit. But first, welcome to Dentist Puns and Money. I am your host, Shawn Terrell. This podcast is brought to you by Dentist Exit Planning. At Dentist Exit Planning, we help dentists leaving clinical practice in the next couple of years build their financial treatment plan for life after dentistry. So just like how Dr. Bill realized he needed to explain dentistry in layman's terms with his patients, it's easier to understand some of these financial concepts if they're explained with everyday language or with everyday examples. And that's especially true with the passage of the One Big Beautiful Bill Act, because above the line versus below the line is, again, in my opinion, now even more confusing than it was before. So I'm going to try to explain that phrase, that concept today in a little more detail with a little more context than is normally given, because I think above the line versus below the line is confusing to 95% of people who hear it. So let's start with a little background. The line that is being referenced in above the line versus below the line is the line on your tax returns that lists your adjusted gross income. For reference, on Dr. Bill's 2024 tax returns, this line is line number 11 on Form 1040, which is usually for almost everyone the first main page on a tax return. So if you're still practicing, your adjusted gross income is likely going to be primarily the salary that you draw from your practice, in addition to the profit distributions that you take from your practice. So think of your above the line number as close to the amount of money you're moving from your dental practice bank account to your personal bank account. Now, like everything, there's exceptions. I'm just trying to give people a broad context for what this number usually is. If you have already left clinical and retired, your adjusted gross income, the above the line number, is likely going to be roughly the total that you're taking out of your 401k and your IRAs to live, plus the taxable amount of any Social Security that you are drawing. There are several things that can reduce that above the line number, your adjusted gross income, before you get to any deductions or anything like that. But in my experience, for a late career dentist that has a strong practice or a retired dentist, there are not many above the line deductions that will really move the needle or make a big dent unless you are still paying alimony on a divorce that was finalized many years ago. Your below the line number, that is your adjusted gross income minus any adjustments, is reduced by one of two things. Either the standard deduction, which is a fixed amount based on your tax filing status, like single or married filing jointly or married filing separately, or your below the line number is reduced by itemized deductions if your itemized deductions in total exceed the standard deductions. Now, the standard deduction tends to go up a little bit each year to account for inflation, but relatively speaking, the standard deduction is a lot higher than it used to be, or a lot higher than it was before the many various tax legislation reforms that have taken place in the last 8 to 10 years. So I heard a stat that 10 years ago, 33% of people itemized on their taxes, but last year, only 10% of people itemized on their taxes, which means that the increased standard deduction, relatively speaking, compared to where it used to be many years ago, is high enough now that it sort of phases out a lot of people that could itemize before, but now it's just easier and it's more financially advantageous to take the standard deduction. So I didn't verify that 33% versus 10%, but I heard it from a pretty reliable source, so I'm going to go with it here. The increased standard deduction that came to be in the last 8 to 10 years seemingly made taxes less complex for many people because, as I just mentioned, there was a lot fewer people that it made sense to itemize with the higher standard deductions. So a lot less people had to keep track of receipts and track expenses in order to figure out what their itemized total was at the end of each tax year. But the big, beautiful bill seemingly sort of reopens the door on a lot of this because it adds a category of deductions that can reduce someone's taxable income further, even if they are using the standard deduction. So this is a little bit confusing, so I'm going to say it a couple times. There are now deductions in addition to the standard deduction. The one big beautiful bill includes deductions that are in addition to the standard deduction. So deductions before that you had to sort of itemize to qualify for. Now you can still take the standard deduction and qualify for some of these deductions. And if that isn't confusing enough, some of these aforementioned deductions after the standard deduction, if you follow that, are considered permanent and some are considered temporary. Now, when you're talking about taxes, permanent is sort of a loose term because it's just permanent until another legislation or another law changes what was permanent into something different. So use finger quotes. But I guess what I mean by that is it's not set to expire, whereas some of these deductions with the standard deduction are scheduled to expire without any intervention or any law changes between now. And a lot of the ones that are set to expire are going to expire at the end of 2028. These new deductions, in addition to the standard deduction, include a deduction for charitable contributions for those that do not itemize, and also a deduction for car loan interest for those that qualify. There's some catches related to people qualifying for that. And the big one is an additional deduction for those that are older than 65. Some potential real tax savings with this one, although it's worth noting this additional deduction for seniors is only good through 2028. And we are going to dive deeper into that specific deduction for seniors that's good through 2028 on the next podcast. So I know a lot of these explanations don't have a catchphrase or a slogan like above the line and below the line, but I hope that while I don't have some buzzword to make all this immediately easy to remember, the slower, more detailed explanation makes it easier to understand what some articles and maybe what you're hearing from other dentists saying in passing conversation about taxes when they reference above the line versus below the line. What Dr. Bill did not have in a clinical setting, and maybe you can relate, is a chunk of time to explain a procedure in detail to a patient. So that's sort of what I'm hoping to do with the podcast, is just go a little bit deeper into above the line versus below the line. So it's actually easier to understand instead of people just hearing it and nodding their head, but really not knowing what's being said. If you'd like to learn more about how the OBBBA applies to you and to your situation, we do have a free checklist we can send to you. Whether you're watching on YouTube or you're listening on a podcast app, go to the show notes for this episode and look under episode resource. If you click there, we will email you our OBBBA checklist. Also, if you are a dentist leaving clinical within the next few years, and you would like a personalized one-on-one consultation with us with Dentist Exit Planning, you can schedule a no-obligation virtual meeting with us. And to do that, you just go to dentistexit.com. That's our website. And then click free consultation on the top right corner of the homepage. And you can pick your time and date that you want to talk via Zoom. One reminder before I go, Dentist Exit Planning is a registered investment advisor. The information presented here should not be interpreted as investment, legal, tax, financial planning, or wealth management advice. It's for educational purposes only, and past performance is not indicative of future results. Thanks for watching and thanks for listening. I am Shawn Terrell, and we will talk to you again very soon.